Harish Krishnan, Co-CIO and Head Equity with Aditya Birla Sun Life, or Aditya Birla Mutual Funds as we popularly call him, joins us now. Good to have you back. How are things?
All well, Nikunj. Good to be on your show as always.
1 month ago, everybody was complaining. Some were worried about tariff, some were worried about geopolitical concerns, some were worried about dollar, everybody was worried about FIIs selling, and then the general consensus view was that earnings would not be great. Today, no one is complaining. So are we in that phase of the market where good news is there, but good prices have also gone?
Right. So we were not complaining about 2-3 months back. So clearly, we had gone quite aggressive into buying equities and
every month.
Risk. So just to give you a context,
mutual funds are getting 24,000 crores a month. You guys cannot complain.
No, but even within, say, our asset allocation products, we were at 38% in, say, our balance advantage fund, 38% in net equities by mid of October last year, when the market momentum seemed to go off, and then sometime by say mid-February and March, we were close to about 70%. So that's the kind of extent of increase in net equity that we did when there was this opportunity where everybody, as you rightly said, was focused only on macro. There was only one talking point, which is that of macro, which is that of how Trump tariff wars are going to derail the economy, or it would be about geopolitical considerations, etc. And our view has always been that, we need to, markets don't work on the newspaper headlines for today. They work on what the likely newspaper headlines can be about 6-9 months from now. And which is where we were saying that there is an improving trend in earnings that we are seeing, and it will be more visible as we get into the end of this fiscal year and possibly towards the next fiscal year. And that, to our mind, with a lot of excesses of the froth going away in terms of valuation, provided us a good opportunity to get in. So that really is a context of how we've decided in terms of the opportunities that came through, even amidst all this noise that was there.
So what could be the next big headline for the market? Since you're talking about predicting the headlines now, right? So what should one focus on?
So it is not about predicting headlines, Nikunj. It is about finding out the rate of change as to where it will be. So we do think that, from an environment of peak macro, we are going to go into more and more into micro, which is that we are going to go into earnings. We are going to go into sectors where there is going to be an improving trend. We're going to see into a trend of improving capital expenditure that's going to happen. So that's really is what we're talking about. Secondly, today there seems to be a over-pervasive environment wherein we're very focused on what Trump is going to do. One has to realize that there is a particular amount of pain that even politicians globally can take. I would be very surprised if they are wanting a very harsh Christmas on their own citizens. And therefore, we are going to see a thaw in kind of these tariff wars, which are going to come through by September, October. It's not going to be smooth sailing that everything is going to normalize as what it was before. But this extensive fear mongering that seemed to be all pervasive, I would think that, that sentiment is going to go away quite meaningfully. So, like I said, it is not about prediction. I don't think any of us have got the accuracy to try and see what the headlines are going to be, but to try and see what the rate of change of each of these variables are, and which is where we are far more constructive on markets as we speak.
All right. Hi, Harish. Good morning. This is Shrishti also joining in. But the last time we connected with you, Harish, you were quite comfortable to place your bets within the large cap space, and the valuations were not that comfortable for the SMIDs. Do you still stick with that stance, and the tilt of the portfolio is still within the large caps, or now is the time when you're finding and looking for some opportunities?
So it's always going to be more bottom up and within various sectors. But broadly speaking, we think that whenever there is a big dislocation in markets, as we've seen in the last 6 months, sectoral leaders of the past are unlikely to be the sectoral leaders into the future next 3-5 years. And if you therefore go by that kind of a framework, there were 9 particular sectors which had underperformed over the course of the last 3-5 years. And some of the leaders of the next 3-5 years are going to be from these sectors. These include private sector banks, include cement, metals, oil and gas, FMCG, insurance, alcobev, textiles and chemicals. So these are the 9 sectors where we are positive upon from a reversion point of view, that there could be potential surprises in store over the course of the next 3-5 years. Now, within these sectors, we then assess as to whether there is a right to win for larger companies or whether there is a right to win for mid and small cap companies. For example, as far as banking is concerned, we do think that there is an advantage for the larger 4 private sector banks over there, and therefore that's going to be more large cap bias. On the other hand, if we were to look at sectors like, say, chemicals, where there is a preponderance of mid cap and small cap companies, we think it is more advantage for mid cap and small cap. So when we look at it in totality in each of these 9 sectors, we do still think that there is a greater bias of large cap within these 9 sectors where there is a greater chance to perform. And which is where, I wouldn't say that valuation is the only barometer to assess whether, one should be in large cap or mid or small cap. But I think this framework gives us a sense that, large caps can be equally as participative as many of the mid and small caps. And given their better valuations and relative margin of safety, we think that that is where we will continue to be in our portfolios.
It's a great point, 9 sectors. So I was able to note down only 4. You said okay. Banks,
so
chemicals.
Yeah. So the private sector banks, metals, oil and gas, FMCG. Then you've got insurance, you've got alcobev, you've got textiles, you've got chemicals. And possibly I'm missing out one of those. But yeah, these are the 8-9 sectors which cement and metals. These are the 8-9 sectors which have underperformed over a 3-5 year period going into this dislocation. And we think that these would be the sectors that are going to lead, or within these sectors, few of them are going to lead over the course of the next 3-5 years.
Cross banks, you like banks, that's a consensus trade. But I'll single out FMCG, underperforming but expensive. So even if I look at the best FMCG company and perhaps a mid-cap FMCG company, P multiples are north of 50-60 times. The volume growth which we heard from HUL was not impressive at all. Competition has intensified, and this whole monsoon story I'm hearing from 4 years, this year will be better because monsoons are going to be better. What makes you bullish on FMCG when valuation and growth, they both are missing?
Right. So I think the companies are doing the right thing, which is that they are getting back to focus on volume growth. So if you look at the largest FMCG player, their margins went up from about 15 percentage points to close to about 25 percentage points in a decade, from 2014 to 2024. Now, that was a relentless focus on improving efficiencies and productivity and profitability levels, possibly seeding some amount of share and allowing competition to come in, be it in terms of direct-to-consumer competition that were to come through, or in terms of other players who can operate at a far lower margin profile. Now, what we've seen, and in fact, that particular company itself has given a guidance that they want to actually tone down margins. To our mind, while this might be negative for earnings in the near term, this is actually what sets up for a good business decision, which is that you want to focus on the long-term health of your consumer franchise, which is built by improving sales salience rather than necessarily focusing only on margins. Let me give another example. We've seen possibly one of these sectors which has been in significant distress over the course of the last almost 2-3 years has been the paint sector. Within the paint sector, if you were to look at some of the larger companies, the revenue levels are lower than what it was in FY23 and FY24. There have been about 6 or 7 or 8 consecutive quarters of revenue decline. Now, in that kind of a time frame where margins have cooled off from about 21-22% to 15-16%, essentially valuations, which is just earnings or market cap divided by profits, where revenues are significantly lower than what it was, profit margins are significantly lower than what it was. And we are in an environment where there is still a significant penetration opportunity. So all of these wonderful stories that we kept hearing during the bull market, when the stocks kept performing, those still come through over a 5, 10, 15-year period. It's just that there is a peak pessimism built in today with no ownership in the street. So which is where we think that is where the potential sources of alpha can emerge over the course of the next 3-5 years. Now, which quarter will any of these catalysts play out? It's very hard to assess. But is there a relative margin of safety built into these kind of franchises? We would like to think so.
All right, Harish, but the other sector that you have flagged off is the metal basket. Well, of course, the biggest trigger is the kind of tariff and the trade deals that have been announced that actually lifts up the global sentiment as well. But in the past 1 year, if we see the index, that has done absolutely nothing. But Harish, my question is that when this sector comes on a roll and starts to shine, there's no stopping, because from the past, barring the last 1 year, if I see the previous 4 years return, that's almost a 400% jump. What kind of a return expectation you have within the metal basket, how well it can do, and within that, which are the pockets that are you bullish on?
Right. So from a fundamental standpoint, we are going to see a reasonable amount of reindustrialization back in the developed world, and that is what this entire geopolitical narrative is speaking about. I mean, this entire spending of defense by, say, Germany is going to lead to some kind of reindustrialization of Europe. We are talking about getting some amount of jobs, of course, not the entire amount, but to get back manufacturing back in US. That is also going to require a reasonable amount of hard assets in the developed world. So while there is going to be a balance of trade, etc., we think that there is going to be a greater demand from the developed world, which is going to come through, which is over the course of the last maybe 2, 3, 4 decades has been on a structural decline. So I think that is one key variable. The second key variable is that of the dollar index itself, which has kind of cooled off from its highs, and as many of us know, especially because they are priced in dollar terms, the real value of these commodities typically tend to appreciate in a weakening dollar regime. So that's the second point. But the third and the most striking point for us is that if we were to plot the profit pool share of the metal companies, what do I mean by that? I take the entire metal sector profits, divide by the top 1,000 companies' profit pools, and we plot this for the last 25 years. It might surprise you and your viewers that the metal sector profits are today back at 2001 levels. So that is the level of the profit pool share that has kind of eroded from metals. Again, these are extremely cyclical sectors. Sectoral profits vary from 2% to 17% of profit pools. So you would ideally want to buy these sectors when they are at the lowest end of the profit pool share in a cyclical sector, and which is what we think that there is a potential trade which could last maybe under 2, 3, 4 years if any of these kind of things, the narrative starts coming true. So, like I said, our focus is on identifying margin of safety pockets where there is very low ownership, where cyclically things are very, very poor, and where there is a potential for a catalyst to play out over the course of the next 1 to 3 years.
Okay, so you've told us what could do well. Now let's understand that if something has to do well, something either has to remain flat or something will not do well, again relatively, not absolutely. Where do you think there is a reason to believe that there would be an absolute and a relative underperformance if you compare that with the benchmark?
So, I mean, we focus on relative, Nikunj, not so much on absolute. So, absolute, they could still do well. The sector that we think, is going to face some amount of headwinds is going to be the real estate sector. Now, this is a sector that has done very well. We've been bullish on real estate for a long period of time. The cycle turned up very, very favorably. But this is a phase where there has been a significant ownership and a lot of supply of paper that came through over the course of the last 2, 3 years. So this could be a sector where there is a lot of positives already being priced in. So even as people focus on inventory levels and say that the cycle can still last under 1 to 3 years, the point is that how much of that good news is already priced in a cyclical sector, which has really exploded its market cap anywhere between, say, 5 to 15 times over the course of the last 3, 5 years. So I would say that could be one sector. Similarly, if you were to look at the hospitality sector, this is again a sector which has been very, very, which has done everything right. So it's not that we are saying that businesses are doing something wrong. It's just that what is being built into these businesses and the supply of paper, the number of listings that we've seen in the hospitality segment over the course of the last 2, 3 years has been significant. And therefore, we believe that, all good things, it is effectively a law of gravity. Everything that goes to the sky eventually has to come off. And therefore, we believe that, the margin of safety in many of these spaces, which are reasonably priced to perfection, is very high. I mean, just to give you a sense, the total hotel sector market cap is close to about 250,000 crores, with a revenue pool of about 25,000 crores. Now, in a sector where margins have gone up more than 1,500 basis points, and rightfully so, given the strong demand tailwinds that came through, one really has to see what is the scope for further surprise in such a significantly overvalued, over-owned sector at this point of time. And therefore, it's not that we don't own hotels in our portfolios. I think the point really is that we want to sell on rises out here rather than commit more capital into the space at this point of time. So there will be many such sectors, where we think that, relatively things are still priced to perfection from a business cycle point of view.
Okay, Harish, great to have you on the show. Thanks for your time as always. That's the takeaway on the market.
If you like this video, then like, share and subscribe to ET Now.